Two more banks are on the verge of failure. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the hits keep on coming for the regional banking system as two more banks now are on the verge of outright failure. And this is coming at a time when confidence in the broad banking system is near all-time lows. But the problem for these two banks is different than it was for the other three that recently failed. We'll take a look at what's going on with them and why this is a beginning of the next wave of bank failures. And are layoffs about to surge? Well, the latest unemployment report says they're about to head a whole lot higher. We'll take a look at that. Plus, we have a sponsor for today's show, and this company is disrupting the on-demand 3D printing space. They just had a major announcement yesterday, and we think this company is poised for big things. Be sure to stay to the end of the show to learn more about them, or check out the pinned comment or the information in the description below. Let's head over to Bloomberg, but before we get there, let's do a stop at the Fed because, well, this statement aged, as they like to say, very well. And here we have going back to the FOMC statement from yesterday. And what do we see here? The U.S. banking system is sound and resilient. And again, in a statement that aged so well, what do we see in overnight trading when we had problems with one bank and then in before pre-market trading today, problems with another bank. And we said this was likely to happen. But what's notable and what's interesting about this, it isn't about deposit flight now. There's other problems. And it just goes to show how there's outright absolutely no confidence now in the banking system at all. As PacWest First Horizon slump reigniting regional bank jitters, and I'll tell you what, this will indeed lead to the next round of deposit flight as once again investors are on edge with PacWest plunging as much as 48% in pre-market trading after confirming some talks with potential investors and partners for a sale. And First Horizon tumbled much as 55% after TD Bank and it mutually agreed to terminate a merger agreement. So let's take a look at what's going on here, because this again is different than what we just saw before. It was, hey, there's a whole bunch of deposit flight. Hey, there's a whole bunch of unrealized losses and this bank is insolvent. Now we have two different pictures, but what we're seeing is the outcome is the same. The stock price is crashing. And what does that mean? These banks are going to need more assets. They're going to either have to sell more stock, they're going to have to borrow more money, they're going to need assets, or they too are going to face failure. The bank has not experienced the out-of-ordinary deposit flows following the sale of First Republic and other news. According to PacWest, our cash and available liquidity remains solid and exceeded our uninsured deposits, giving the suggestion is, well, if everything's okay on the deposit side, well, why is PacWest stock all of a sudden tanking? PacWest has been considering a range of strategic options, including a sale, a breakup, or, as we just mentioned, a capital raise. Again, the bank needs money, and while it is open to a sale, the company hasn't even started the process, and an outright sale has been hindered because there aren't many potential buyers interested in the entire bank, which comprises a community lender called Pacific Western and some commercial and consumer lending businesses. A buyer would also have to potentially book get this, a big loss marking down some of its loans. So the issue here with PacWest is more to do with the fact is, well, wait a minute, if they're not experiencing deposit flight, and that was the catalyst for the last three banks that are failed, and they're looking at selling themselves, well, there must be something really wrong underneath that we can't see, and all of a sudden that sends stock price crashing at a time when they already need to raise assets because they're looking at a sale. So now all of a sudden you can see that any sort of jitters put out by the banking industry is going to cause the stock price of these companies to crash, and in turn they're going to need even more assets they need before, and next thing you know, perhaps the government will be brokering another sale to a big bank. The move in reversal to TD's push into the U.S., now switching banks here at a time when the nation's regional banks are being roiled by deposit outflows and investor caution after a series of smaller firms collapse. Banking indices have fallen more than a third since the first deal was agreed. Here you can see First Horizon crashing by almost 52% in pre-market trading today. So what's going on with TD? Well, this is a simple deal. They were coming in to buy out a U.S. bank, and you can imagine, would you want to be buying a bank and going into this potential crisis? Well, no, it cost TD Bank to get out of the deal, but I'll tell you what, smart money on that move, because the last thing you want to do is get caught up in what could be a tidal wave of U.S. bank failures. Who knows how the government and policymakers are going to react? I'm sure they've got problems of their own up there in Canada, but this is separate because this is a big issue in the U.S., and this is telling us TD Bank knows something is going on. They wanted out of the deal, and again, that bank, their stock price crashing too, now putting them in a position to raise capital, go to the Fed or other home loan bank, federal home loan banks, to get money to keep these solvent. Again, we have these two banks on the verge of failure when they shouldn't be failing at all. And this slide comes as prominent investors, including hedge fund billionaire Bill Ackman, warn the stresses on the banking system are far from over, a case we have been making on the show now for months. It puts into focus concerns that policymakers need to do more to shore up smaller lenders that have suffered as the Federal Reserve raised interest rates. And this is a problem because, as we saw, that the government seizure and sale of First Republic Bank was an important step of drawing a line under the period of severe stress. And what do we see? Days later, this whole thing starts to fall apart, because in part it was due to the rapid increase in the federal funds rate, which put a lot of these banks, not only their loan portfolio, but their investment portfolios underwater. It caused deposit flight, which we'll now see more of. As you can imagine, people are going to look out and say, wait a minute, these two banks, we got to get our money out and go elsewhere, particularly since the Fed is offering even higher rate of return on money markets now. So you see the problems are not only just twofold, but threefold, because remember, the money supply is still contracting. And this puts us in a picture of a lack of confidence. This is not something you want to have for the banking system, as nearly half of Americans worry their bank deposits aren't safe as well as they should. A Gallup poll released Wednesday showed that 48% of Americans are very or moderately worried about their money following the worst spate of bank failures in 15 years. Only 20% say they're not worried at all, and you can only imagine that those numbers are likely to go up. And you're going to see what we know in the past is banking crises are highly deflationary. It doesn't cause people to go out and borrow money. It causes them to worry about their money. But the next thing that everyone's going to have to worry about, well, that will be losing their job. And back to the Fed, who noted, because why not, that they said job gains have been robust in recent months. Well, my friends, that is about to change in a big way as U.S. jobless claims rise to 242,000, the biggest increase in 6 weeks. Now, I want you to remember, what was that line in the sand? You remember what we've talked about in prior shows? It's a 250,000 number. Now, historically, it needs to be closer to 350,000 claims before we really see an acceleration. But when we come off very low numbers, which we have during this last cycle, the 250,000 number seems to be where we start to see an acceleration. We're getting close to that, but there's other evidence that says that indeed we're going to see a whole bunch more layoffs in the future. Initial unemployment claims rose by 13,000 to 242,000 last week, continuing claims. So there's a little bit of good news, which includes people who have received unemployment benefits for a week or more, are a good indicator of how hard it is for people to find work after losing their jobs. Fell by 38,000 to 1.81 million. That marked the biggest drop since July, but notably that number has been hovering right around that 1.8 million number. So it is a nice drop, but hopefully it is a continuation of a trend lower. If it's not, well, look for more pain, but that's not the whole story. A separate report out Thursday showed U.S. worker productivity declined in the first quarter by more than forecast, and labor costs accelerated, underscoring ongoing inflation pressures. Here we can see this from the unit labor costs. This number went up. Now, it was a preliminary number, so we don't have the final, so it won't be shown on this chart, but we can look throughout history, and when we've seen unit labor costs compared to the consumer price index, well, what it's telling us right now is that labor is expensive. So if you're looking to hire, you're paying a high price for. But the problem is when we look at the productivity chart, well, it tells us there's a big difference here in terms of output per hour. This is labor productivity shown in blue, and this actually went down. So what we're seeing here is that businesses have a problem. You'll note that when productivity is low, and if we showed the other chart overlaid and cost of employees are high, you typically have a recession, because when the economy slows down, well, what happens is if you have a bunch of high cost, unproductive labor and you're a business, well, what do? You lay them off, send them to the unemployment line, and that's why we start to see initial claims start to head higher. You're seeing all the evidence we need to suggest that the more pain for the labor market is coming soon, and that too is going to be bad news for the banks. But one thing that has some good news is our sponsor for today's show, that is Shapeways Holdings, and they are indeed one of the leaders in on-demand 3D printing. Let's take a look at their website. I want to share with you some information about them. And here you can see their website, shapeways.com. Of course, links to all of this in the description below. They create, customize, streamline, and save. They break down the barriers to 3D printing. Let's take a deeper look here, because they've got some great technology. They've developed a purpose-built software and maintains a wide selection of materials and technologies to streamline the supply chain, lowering manufacturing barriers, and expediting delivery of quality 3D printed products. So what's key here is they have their own software, which is phenomenal. They also are a leader in on-demand printing. You need something done, you go to Shapeways. Again, pull up their stock here, SHPW. That's on the New York Stock Exchange. Again, SHPW. We'll talk a little bit more about that in a bit, but I want to share more with you about what's going on with this company, because they had a major announcement yesterday. I want to get to that. They've manufactured over 21 million parts, if you can imagine that, to 1 million customers worldwide using 10 different technologies and 90 different materials and finishes, delivered to a whopping 160 countries. Can you imagine? This company has a massive footprint, and here's their announcement from yesterday that just came out, that they announced a significant milestone that accelerates the growth of its software, tools, and services, and this is going to have a big impact on their business, which is one of the reasons they wanted you to hear about them. Again, symbol SHPW on the New York Stock Exchange. Because with their release of their orders and transaction functionality via its MFG brand that they purchased last year, what this does is a suite of powerful new features enables Shapeways to increase customer acquisition, improve customer retention, and enhance customer lifetime value. And they've seen a surge in sales growth here in the first quarter, which is one of the reasons why they think their stock is going to head a whole lot higher. And we'll get more into that in a minute, but let's look at what's going on with this company. They acquired MFG last year, and the new features, and what they did is, this was really smart. They listened to their customers, put those ideas into the software, and next thing you know, they're seeing a huge demand. And look at this. After a recent survey found that 92% of MFG's buyers wanted this feature, and that meant they wanted to send invoices and buyers to pay for their service within the platform. Well, the development team made it a priority, and check this out. They streamlined the process for both buyers and manufacturers, and this has turned out to be a huge boom in their business. Look at this, highest quarter on record for both manufacturer registration, live products, for quoting and SaaS contract commitments. And look at this, they experienced a record-breaking first quarter here. They're excited about the momentum they're seeing in the market and welcomed a record number of new manufacturers to the platform. Of course, new business means, of course, revenue is going to go up, profit's going to go up, and they're really keenly focused on their bottom line. They're looking at having profitable growth. One of the issues they faced is they've had a lot of expenses, particularly with the acquisition of MFG, and they're looking to continue to make improvements here now. The company has achieved a 43% gross margin for the year, and they are focused on improving their cash burn, getting their expenses down, and their profits higher here this year. And they're also planning on having a reverse stock split. In June, they're having a meeting, and they're looking to do that because, of course, at the current price, there's some risk that they could get delisted by the New York Stock Exchange. They're keenly focused on their stock price going up. That's behind the decision to buy MFG, the decision to implement this. You're seeing the growth this year already, and they're looking to take their stock price to whole new levels. Let's take a look at the charts here. And what do we notice? That this currently trading around 27 cents a share with a volume profile line at around 67 cents, where we see most of the shares are traded. It's been sitting in oversold levels for an extended period of time now. Of course, with this recent news, I know Shapeways is looking to see their stock price head a whole lot higher. Again, symbol SHPW. And here what we can note, looking at the last 30 days, there's a whole bunch of buyers sitting here right around this 27 to 28 cent level. And of course, on this news, stock was up a little bit, and they're looking for it to go a whole lot higher. But with anything, of course, we're not suggesting or asking you to buy any shares in Shapeway. If you feel that Shapeways is a benefit to your portfolio, we ask that you do your own research before making any decisions. We've got links to everything in the pinned comment and in the description below. Put SHPW Shapeways on your hot list. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.